Does an inverted yield curve mean the U.S. economy is going into recession? This is Wes Moss. Welcome to Money Matters. And we are going to go over an explanation of what you've been hearing in the headlines, an inverted yield curve in the year 2019. It's an important economic barometer, and it has historically led to a relatively high probability that the U.S. economy goes into recession. But there's a lot of caveats to that, and you're going to continue to hear about it in the news. I want to go over what the potential implications are. First, I'm just going to draw out what an inverted yield curve looks like. First of all, on the y-axis and the x-axis, this is time, and this is our percentage interest rate. We know that normally a yield curve should look like this. More time, let's call this a 30-year government bond, should pay much more interest than short-term government bonds. Much higher interest up here for a 30-year versus a short-term bond that should just pay a tiny bit of interest. Call this 0%, call this 5%. In an inverted yield curve, this naturally upward sloping line goes almost upside down so that we have shorter-term bonds paying more than longer-term bonds. So it can mean a couple of different things. First of all, in 2019, we see the general yield curve, or interest rates in general, coming down to historic lows. That in itself can mean that the U.S. economy or the bond market that's moving these interest rates is looking out and saying, hey, we could be seeing an economic slowdown around the world and potentially here in the United States. When the yield curve inverts, and here's the data behind this, if you go back to the 1970s, the yield curve is inverted 5 times. 4 out of those 5 times, the U.S. has what has followed is an economic recession here in the United States. So it's not a perfect indicator. Again, 5 inverted yield curves, upside down yield curves, that have led to 4 recessions. So you might hear in the news, every time we've gone into recession, it's been preceded by an inverted yield curve. But not every inverted yield curve has been followed by a recession, and that's the nuance of the media trying to scare you. In fact, in 1998, we had an inverted yield curve, and we didn't go into recession. It was another full 3 years plus before the U.S. economy went into recession. So it's not a perfect indicator. However, it is something worth noting. It is an important economic barometer. What happens, though, historically? What's the history behind this? How long does it take? And then what does the stock market do? Well, first of all, on average, the 4 times that we did go into recession after this inverted yield curve, it took on average a year and a half before the United States economy went into recession. So it's not as though we've gotten a yield curve inversion and then the next day we're in recession. That just hasn't been what's happened historically. The next part here, and again, as I do this video, the U.S. economy is still in decent shape. It's in actually pretty good shape. So it's hard to forecast that in a year and a half or 2 years from now, we'll go into recession. We just don't know that at any given point in time. The second, and I think important part of this video has to do with what does the stock market do? When the yield curve first inverted in 2019, there was a massive sell-off just that one day. And I think part of that is computer algorithms being programmed with historically this means the U.S. is going to recession, so the stock market sold off. But the reality here is that historically, let's go back to those same 4 periods of time when we got an inverted yield curve. But between the time, and this is on average, between the time the yield curve inverted and the time we went into recession, on average, the U.S. stock market went up 15%. In fact, the 1998 example that we talked about where the yield curve inverted and we didn't go into a recession, the market went up about 40% before we went into the next down cycle. So what we're seeing here is that, A, there could be a lot of time, if the indicator is right, number one, we may have a lot of time before the U.S. economy goes into recession. That's number 2. Number 3, the stock market historically has done really well during these periods of time between inversion and recession. I hope this puts into some context what a yield curve is and then an inverted yield curve is as an economic indicator. Yes, it's an important indicator, but it isn't an exact hard and fast rule, just like most things in economics. But this will give you some context around what historically happens between the time we see this and recessions, and then what the stock market does during that period of time historically. We are here to help if you need us. You can find more videos right here on Wes Moss Money Matters. If this video was helpful, I'd ask you to hit subscribe below. Thank you so much for listening and hope you have a profitable rest of your day. I hope you found this video helpful. There are lots of other videos on this page that'll help you be a happy retiree. Just hit subscribe right below this video. You can find us or follow us at Wes Moss Money Matters on Facebook or Instagram, Wes Moss Money Matters, and Twitter at Wes Moss 365. Thank you so much.